What if I told you that income and giving, tax planning, and legacy could weave together in a beautiful tapestry of generosity? If that kind of a blanket warms you up, stick around for today's episode. All right, grab your favorite mug. It's time for coffee with your retirement coach. Welcome back to Coffee with Your Retirement Coach. Clipboard's up. I'm Aaron. With me today, I've got Randy and Nick. Guys.
Hi, Aaron. How are you?
Aaron. Continually inspired by Marietta's generosity. We're going to have to continue in that flow. We got great response. When Glover Park did their concert series, they did a big focus on this that we were a part of here a few weeks ago. What a great event. So we want to stay in that vein. We got an incredible response. This is a practice that we've got clients already participating in. It doesn't apply to everybody.
Right.
This is an extended level of generosity, and we get that. But here's what I would say. You might want to stick around because this might be you. You might want to stick around because this might benefit someone in your family that you are the downline of. You might consider yourself an heir possibly of what's going on with them. Or if you're a part of an organization that could benefit from the CRTs, or Charitable Remainder Trust, you're going to want to hear what we've got to talk about today.
Good job.
Thanks, Randy.
Oh,
you're welcome,
and with that,
we're going to wrap it up. I got a compliment from Randy. We're done.
Today we are gonna talk about continuing in the vein of generosity. Again, Marietta being named by GoFundMe as the most generous city in the U.S. is incredible, right?
Awesome.
And so while we have clients, in so much of the United States and Metro Atlanta, I do think that's really cool. We operate our business here in Marietta, Georgia, and we do want to celebrate that.
Yeah, and you know what, Nick? Our clients all over the country are generous.
Yeah.
I mean, I think that there is a theme. I don't know exactly why, but we do seem to have some pretty generous clients.
Yeah, well, and they're also some of our most joyful, most content, fulfilled clients, and it's a pleasure to serve folks with that generous spirit. So today, what we want to talk about is how do you maximize that generosity? This is kind of part two, right? Like of our initial episode, but we want to continue and talk about some of the tools and techniques that you can use to further the benefits, so tax benefits, the legacy benefits, as you mentioned just a moment ago.
Right.
And it starts with this idea that is a unique tool. And like everything we really talk about, seek wise counsel, right? Get prudent advice and guidance from experts.
Yeah.
But the Charitable Remainder Trust, in my opinion, especially for I'll say the middle-class millionaire, it is something for a lot of people to consider, because if you are generously minded, it is a tool that in a very short breakdown, it does these things. One, it creates a really nice tax advantage, a big tax deduction. Number two, it creates an opportunity for you to do a big Roth conversion to transfer more money tax-free for your life. Number three, it can give you a pension for a period of time or your lifetime.
Yeah.
And then lastly, you now have a really nice bucket of money that's going to pass to the organizations you care about.
Yeah.
And your heirs now receive a tax-free pool of money from the Roth. So if we were just to boil it all down in what today's episode's about, it's about the advantage a CRT potentially creates, which is so multi-pronged.
Yeah, I think the tool, like so many of the tools we talk about, in conjunction with other tools, that marriage of good planning allows people to the best they can to have their cake and eat it too.
It's so funny that you said that, because I was literally just thinking in our last episode, we talked about turbocharging our plans. I'm like, this is like a cake. And then that Roth conversion is icing that cake. I mean, it really is taking a good situation and making it even better.
Well, there's income and respective decedent. There's this idea that down the road, the potential risk for taxes is pretty substantial.
Yeah.
So this fits a certain client group. But the reason a lot of people don't do these more advanced planning techniques is they're not aware of them.
Right.
And a lot of times, because of the complexity, which we'll touch on a little bit, people don't want to mess with them, because there's a lot of work involved in doing the right kind of planning to make this work.
Well, and there's a trigger word in there that for a lot of people in what I call, middle or upper middle America, and that's that word trust.
Yeah.
So a charitable remainder trust, for a lot of people, they kind of get weird around that term. And so for our audience today, there are a lot of different types of trusts.
That's so important.
The basic revocable living trust, which is kind of plain vanilla with some sprinkles, to what we're talking about today, which it does have some moving parts, but it's not the super robust, crazy trusts that do exist, in the Cayman Islands and all that kind of stuff. This is, a bit more involved, as you said, Randy, does need some technical expertise involved, but like anything else of quality,
oh man,
if you bought it for its intended purpose and you set it up right, it can have really big benefits.
Right. So I think it might be good to do like an example of how somebody might marry these concepts, like what they would have to have. They'd have to have charitable intent. Like, in other words, you wouldn't do this just for the tax deduction. So the legacy aspect, the fact that you are intentionally leaving assets to an organization or a church or charity of some kind that you care about, and it's important. I think that has to be an important part. And then trying to use that generosity to make a greater advantage to your own lifestyle and your heirs. So give us an example or two of how somebody might package these things together and get the best of both.
Yeah. So, I'm going to change up some names just so that these people wouldn't be identifiable, but a great couple. I'll call them Jim and Margot, because why not? So Jim and Margot, charitably inclined, give big gifts every year, and their intention was to continue to give big gifts. Like so many others, the majority of their wealth really was in retirement plans, so 401ks and IRAs. But they also had money, in traditional brokerage accounts and bank accounts that were, non-qualified assets, so not in those tax wrappers of retirement accounts. And so what we identified is that and they didn't have children, so they wanted to bless their some nieces and nephews, but they weren't trying to leave a big legacy to little Timmy or little, Janie.
Yeah.
So here's what they did. They identified approximately how much income they would like to have from a pension type standpoint. They identified about how much they wanted to convert to a Roth to continue to build tax diversification, so increase how much tax-free assets they have. And then what we did is we rolled up our sleeves and we got to work, okay? And so what we did was we did some calculations. We said, if you, and I'm again changing up the number just a little bit, but if you gave, $1 million into this charitable remainder trust from your non-IRA dollars, you would receive somewhere around $190,000 of tax benefits.
Yeah.
Okay. So then we worked with their CPA and we asked the CPA how much money could they convert from a 401k or an IRA into a Roth IRA to offset this, roughly $190,000 of tax benefits.
Yeah.
Right. And so then they gave us a number, and I don't remember exactly what that number was, but somewhere in the $600,000 range that they could convert. And they would then have, this kitty of money growing tax-free forever.
Right.
Now, this $1 million ended up creating $50,000 of income for his lifetime and her lifetime.
Right.
So it was a joint survivor. So whoever lived the longest, it was going to continue to pay
when you say
for
forever. You mean as long as they both live?
As long as they both live.
Yeah.
Yes, thank you.
Yeah.
Yep. Now, here's where, you've got to pay attention to the rules. You've got to know the rules.
Yeah.
So in order for them to maintain that big tax benefit, you have to have at least 10% of the initial contribution that was given to the Charitable Remainder Trust still exist after you.
Yeah.
That is dedicated, that will go to the church,
So
the
in
charity,
that
the
particular case,
nonprofit.
$1 million, $100,000 at the end of the day.
Is the minimum that would have to still be in there.
And there are some pretty interesting calculations that have to do with the discount rate and other things. So we definitely want to work with the accounting folks to do these calculations.
Yeah, no, and to your point, Randy, there's a lot of work. there are some cumbersome, and there's some nuances around this. So you do want to seek wise counsel here, because the types of deductions you get, its limits against your income, there are so many things that are factored in. So it's not just so simple.
Yeah.
I'm making it plain for our audience today, but there are a lot of moving pieces.
Yeah, absolutely. And the payout percentage. So there's those little calculations in that. But again, if somebody is getting some guidance on this as to what they're trying to do, somebody who has maybe a really large estate, somebody who is going to, and this is great that you're talking about, I know who you're talking about. So the other thing is, like many of our clients, I find that their biggest thing is what they're doing right now in their own lifetime and getting the benefits. And many times people are leaving to charity at their death a big part of their estate, which is still part of this planning at times, but they don't get any deduction for that while they're alive.
Right.
So they don't get the advantages of doing tax planning during their lifetime if just some of what they leave or all of what they leave when they die goes to charity.
Great point.
That's great,
Yeah.
but they didn't get any now benefit. So this is kind of giving you're already going to be given to charity anyway. You're confident and sure you're going to do that because this is an irrevocable strategy. And, it's not something you can change down the road, but you can get the tax benefits today instead of when you die.
Yeah. And, I'm not sure what language you were just talking about, but, I've heard it pronounced maybe irrevocable.
What did I say?
Irrevocable?
Irrevocable.
Okay. All right. Is that the Canadian way to say it?
Eh?
Wow.
Okay. All right. So anyway,
I could do it again.
round out in the boot. Shout out to our Canadian family. But here's the thing. If we were to think about this strategically, sometimes when they hear that word irrevocable or
Irrevocable.
That can cause somebody to pause and, do I really want to do that? Because most of the time it's a lack of commitment. I don't know in 15 or 20 years if I'll still want to give that amount of money to that particular organization.
Yeah.
And so what's really cool about this type of trust is even though it is
Irrevocable.
Or irrevocable.
It's a one-way street.
You can do a change of beneficiary in the future
To another
charity or nonprofit. So you can change your mind. It could be multiple nonprofits, multiple charities. You do different percentages. Again, you can change your mind. But Randy, what I really like is a planning tool that I think a lot of people overlook. Do you know what else you could make as the beneficiary? A donor advised fund.
Yeah.
And a donor advised fund doesn't have to go away, and it can continue to make gifts for the next 10, 15, 20, 30 years down the road. And you can even put somebody in your family, someone you trust, in charge of that donor advised fund to continue to make those really important gifts on your behalf.
Nick, not only that, but those folks that are using the CRT while they're alive to get the breaks and make the specific changes, if there's additional funds that they're going to leave to charity, that same donor advised fund could receive those benefits too. So again, marrying these tools together with a good plan can be extremely powerful.
Yeah.
I
had a client that came in, we were neck deep in this, and it went so great because first they came back and they were like, my CPA said this was a great idea and I'd be a good candidate. And then there was the follow-up questions. And I thought I was ready for everything that she was going to ask her and her husband. I thought, is it going to be something about the underlying investments, the need for legal documents, those things? She said, what if they find a cure for cancer? And that was when I told her about the change of beneficiaries. It was so funny. I was like, of all the things that we're going to get hung up on, I said, okay, well, as long as it was something else charitable. So when you said that, Nick, I was like, I've got to share that story because it was so great. Because he's looking at me and she's afraid. And she said, what if they find a cure for cancer? I was like, that's so sweet. That's so sweet.
Yeah. So again, for our audience today, Charitable Remainder Trust can be super, super powerful tools. There is that element of irrevocability or
irrevocable.
And so we do want to be mindful of that. But like anything, I'm sorry, just one quick thing. Like anything, doing something like this, you want to do it really well. This is not an area where we cut corners. This isn't an area where you would try to pinch every single penny or squeeze all the juice out of the grape. This is an area where you get what you pay for. You want to make sure you're working with the right experts who know how to do this. Yeah. And if you are qualified to do this, if you are the person that is really a candidate to do this type of planning, it can be super powerful.
Yeah.
I would just add, there would typically be an expense getting the planning done. There'd be an ongoing tax return that needs to be done. And it isn't a simple return all the time because of the structure of what the assets are in the CRT and the payout, et cetera. So this isn't like one and done, like the donor advised fund might be a simplified version of that. So there is some more complexity. But before, we don't have a lot of time, and I know we're not going to try to give all the technical details today, just the warnings about that. But tie that better to the Roth conversion, how you've seen that Roth, like exactly how does that work, that marriage of those two, and how powerful that's been for us.
Yeah. So again, if I'm working with a CPA on the client's behalf, what we're going to do is, one, we're going to determine, are there appreciated assets that we're going to contribute to the donor advised fund? So as an example,
or the CRT in this case,
the CRT, the Charitable Remainder Trust. So NVIDIA stock, or Meta, or
whatever,
Amazon, whatever.
Stock.
It could be a mutual fund, could be again a piece of real estate. There's a lot of things that you could do. Okay, so we're going to identify the right asset. We're going to identify, is there an income we're trying to solve for out of the Charitable Remainder Trust, and then we're going to look at their whole tax picture. How much do they have that's taxable? How much do they have that's tax deferred? How much do they have that's tax free? So if we're trying to solve, like we are in many cases for our clients, for tax optimization, and we're trying to further advance more tax advantaged and tax free assets, we work with the CPA to determine how much of what asset do we put into the Charitable Remainder Trust. What is the tax benefit that is created?
Yeah.
So what's the tax deduction?
Yeah.
How much are we saving in tax? And then we back into that based on those tax savings, Mr. or Mrs. CPA.
Mm-hmm.
How much can we convert from our IRA, 457 plan, 403B, 401k? How much can we convert from there to a Roth IRA that would cost us that amount of money in taxes to offset that tax benefit? Essentially, what we're trying to do is wash out the tax benefit with the tax that's created. It's never perfect. I've never seen one perfect, but you can get pretty dang close, okay? And then, so now you've got this beautiful asset of the CRT that it's going to give you a big tax benefit. It's going to, potentially grow over time, give you a good income, and then ultimately benefit those organizations you care about. On the flip side, you have now taken more tax optimization with this Roth IRA that's going to grow tax deferred and will be tax free forever and ever as long as you have it. Yeah. So your heirs now potentially inherit a tax free asset. Yeah. So the CRT is a great tool to further tax optimize somebody that is really wanting to move in a more tax favored position.
Yeah, and I just mentioned, so somebody who has a diversity of assets, maybe even a disproportionate amount of retirement accounts, and wants a way of improving that mortgage, that liability to the government there, that would be a good candidate to look at this. Somebody that's higher net worth. And also what we're running across today too, some business owners who have, low basis in their company stock. They're doing an equity sale of their business, and they're going to have this big capital gain tax right now, using some of that company stock, doing some planning around that. So look for some triggers, some things that would be a part of that, and don't overlook this tool because of its complexity.
100%. And I've got a great actual example. I've got a friend of mine who retired from a big company here in Atlanta. You would know the name of, and he was awarded as part of his retirement package. His company, it went public, big stock, okay, not in a retirement account. Right. And he's receiving it, and it's going to be completely taxable to him. He took this, he put it into the CRT, got a big deduction because he wasn't going to get a big pension. He wanted a pension. He wanted great income. And he and his spouse are extremely generous, and they wanted to be legacy minded with their generosity. Right, yeah. So this was a great tool for them. And here's an example. He worked for a long time with a big company, went public, granted a lot of stock. As he received it when he retired, all taxable, and he was able to offset that tax with the charitable remainder trust.
Last part of that, then I think the biggest mistake somebody might make in doing this is getting a big tax deduction and doing nothing with that deduction.
Yeah.
Feeling good that you reduce the taxes for the next few years, maybe for a long period of time, instead of doing what you're talking about, which is look strategically at your other assets and your overall financial and legacy plan and marrying those two together. Don't just do one, do the whole thing and get the maximum benefit of it.
And I would add an extra piece of homework to that. In doing this, it's two parts. You need to work with your financial planner and with your CPA. There's a lot of variables. You need to work with your financial planner to say, hey, of our overall assets, this is what we have that's taxable. This is what we have that's tax deferred, and this is what we have that's tax free, and set a goal for the tax free column. Like, have a better understanding of how you are laid out according to what we would call the tax matrix. How balanced are we in those areas, and have some goals set so that as we're talking about these things, as important as it would be to say, hey, this is our budget, so that we can know how much income do we need from a CRT. Making sure that you go in having a good idea about you so that you can work, in a very competent way with these professionals. I think those two things would be super important.
And while I completely agree with you, Aaron, conceptually, here's the problem.
Yeah.
That doesn't happen.
Yeah.
So many times, the investor does not know how to communicate what we're talking about today to the financial planner, to the CPA, and so and to the attorney. It's not coordinated.
Yeah.
And that's where the birthing of your retirement coach came into play. Is we saw all of these great ideas fail.
Yeah.
And so, the idea is to have somebody in your life who can help you coordinate this.
Yeah.
It is complicated. There are a lot of moving parts, but we want the CPA talking to the attorney who's talking to the financial planner, et cetera. We want those people talking on your behalf because that's really how winners win. That's how you win.
Yeah. And we want to win. If this sounds like it's a part of your winning strategy, or it should be, and you've got more questions, you've got things that are a little bit more nuanced, we want to have you reach out to us at connect@yourretirementcoach.com. We're talking about being generous. Again, the best way to be generous is to share this episode. And the way that you're not going to miss an episode is to like and follow us on your different platforms. We hope you've enjoyed today. We appreciate you being generous with your time and want to encourage you to stay coachable. We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@yourretirementcoach.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. On behalf of our coaches, we want to thank you for listening and for being coachable.
Yeoman's Consulting Group, a registered investment advisor YouTube channel based in Marietta, Georgia. We strive to provide comprehensive wealth management services for every stage of the journey. This platform is solely for informational purposes and is not offering advisory services or sales of securities. Investing involves risk and possible loss of principal capital. Comments by viewers or recognitions are no guarantee of future investment outcomes and do not ensure that a viewer will experience a higher level of performance or results. Public comments posted on this site are not selected, amended, deleted, or sorted in any way. If applicable, certain editing of personal identifiable information and misinformation may be deleted. The opinions expressed herein are as of the date of publication and are subject to revision due to changes in the market or economic conditions and may not necessarily come to pass. Just come in and record. Learn more at thepodium.studio. Step up to the podium.